Hi everyone. So today is our seventh session for investment analysis, and we will be covering the regulatory and audit process as well today as well. So we have been talking about few yeah few sections in the last session. So today I will start off with the Standards Advisory Council or SAC. So as you know, the SSC basically comprises of like 30 members. These people are kind of mostly appointed by the trustees for a term of 3 years. So like when you look at the aim of this committee, the committee is basically providing like a forum for kind of a wider participation, like to those who are having an interest in the standard setting process, right? So when it comes to the council, they kind of meet out at least thrice a year. So obviously for 3 years, they'll be meeting for at least like 9 times with the objectives of like giving advice to the board on like certain agendas, decisions, and like the priorities for like the future work, or like even related to informing like the board of public views on this on major standard setting processes, and giving the advisors to the board or the trustees as well. So moving on, hold on. Yeah. So now we are moving on to the standard setting process and the way the IFRS are used by the countries. Now we were talking about different committees and um, what they do, but now we will be looking into how these IFRSs are used by different countries. So basically, when we look at IASC, they basically urges the IASB to kind of work effectively and efficiently using the IASs, and then the board like will form kind of like advisory committees and specialists related to all these projects, and then kind of choose outsource work to the national standard setters. So when we were talking about IASB, I mentioned that they will be merely kind of working through with the national standard setters and with the country representatives in order to kind of efficiently incorporate whatever is included in the IASS. So now we will look at the steps involved in developing the standards. So basically, now when it comes to the early stages of a project, what happens is the IASB kind of establish a advisory committee in order to like advise on the issues arising from this project. And there will be like a consultation with this committee and the SAC occur through this project. So now when it comes to IASB, they will kind of develop and publish these documents for the public to see and then comment upon it. And then following the receipt of the review of the comments, what they do is they will develop and publish the exposure draft for the public comment again. And after that, when they receive that, the comments are being reviewed again, and the IASB may hold like a public hearing in order to carry out the field test and then issues like the final IFRS along with any dissenting views expressed by an IASB member. So now adaptation as local gap. So now we will be looking at how this adaptation happens. So when it comes to the countries where the accounting profession is not well developed, they basically use the IAS with little or no amendments. because they don't have that local standard. So the advantages of this is because that way the method can be adopted very quickly, but the disadvantages, it does not take into account the local traditions and variations. Now, so Bangladesh, Armenia do these things. So adaptation of these standards are easy. However, we need to understand that local traditions are not incorporated when there is not they then they don't have like a properly developed accounting profession. So now model for local gap. So some countries use IASs and amend them to suit their local needs. That is what basically most of the countries do, because they have to adapt according to the local needs and the conditions and what types of um, traditions and variations are there in the country. So accordingly, the accounting standards will cover like areas which are not covered by IASs using the local accounting standards, and the IASs will be used in order to identify a specific direction. So another way is using the persuasive influence in formulating local GAAPs. So some countries basically have their own standards set before origin of the IASC. You know, the IASC was developed in 2000. So there are obviously countries who have developed their own accounting standards way before that. So these countries, do they like fully follow IASs? Obviously not, because they have their own accounting standards which were set before IASC was even, formulated, right? So what they do is their standards, they like try to minimize the gap between the standards and the IFRS, and they will kind of come up with like new or revised standards, and like they will obviously look into take into account all the international standards that comply with the main things related to it. However, uh, the thing is they will try and change it a little bit. However, they will be mainly following their own local standards in line with the IASs as well. Now we will be moving on to the framework. So now when we look at the framework, we can broadly say that there are 7 main headings which including the objective of the financial statement, the underlying assumptions, and the concept of capital maintenance. All these are included in the framework. So basically what happens is framework will cover like the objectives of the financial statement, the assumptions, what are the assumptions that are used when the financial statement related IASs are kind of prepared, the qualitative characteristics of the financial information, the elements of financial statements, the recognition of the elements of the financial statement, and also like things like measurement of these elements and concept of capital maintenance. All these will be included in the regulatory framework. So, so now I will be talking about each section here. I know it's a lot of theory, but we need to kind of understand what this framework is. I mean, how it kind of works on, right? So, objective of the financial statement. Now, if you look at the objective, it is basically, what is the objective of a financial statement? Why do we use the financial statement? It is to basically provide information, right, related to the financial position or even the performance, and sometimes it's for some kind of comparison to identify the financial comparison position related to different economical decisions or even related to other company information. So, and also look at the past transactions, and to do a lot of comparison and try and understand the situation of the company. So that is why the financial statements are prepared, or the purpose of the financial statement. Now we will move on to the underlying assumptions. So now there are two main underlying assumptions that are outlined in like a framework. One is called the going concern, which is basically the assumption that the entity will kind of continue operations for foreseeable future. I mean, like, we need to understand that, okay, right, this company will be there in like the year after or in another 5 years. So that is the kind of assumption that they have. That is the first assumption, which is called going concern. Then the other is called the accrual basis. Now, accrual basis is basically recognizing the transaction when they occur, and then they are recorded in that particular accounting period. So now example, there are certain transaction which occur at a certain time, but maybe the payment or whatever, the full transaction does not complete at that particular time. Like example, when it comes to like a credit. So some, if you take a basic situation where, there is a credit sale, right? When there is a credit sale, what happens is, does the cash come in? No. You sell whatever goods, but you don't get the cash at that particular time. However, you get it a bit later. But in accruals basis, what they do is, when that particular transaction happens, even though you don't get the cash, you include it as a transaction, and you include it as like something that you're supposed to get later on, right? So that's why what accrual basis means. Now, the other thing is the qualitative characteristics of financial information. Now we need to, now what are the qualitative characteristics that information usually that users use? There are mainly 4 qualitative characteristics. One is understandability. Basically, now when it comes to financial information, it has to be understandable, right? So basically here what they say is, like, they have this assumption that that particular the users have a reasonable knowledge related to the business or the economic activity, so that hold on, they will be able to they will be able to understand whatever we prepare, and information can be can be studied properly by these people. So that is understandability. The other qualitative characteristic is relevance. So what is relevance? The information which is provided should be something that will help the users to kind of evaluate the company before making a decision. So they should, the user should be able to kind of figure out, okay, right, this evaluate and see, okay, right, does this help the organization? Like, can you compare between two companies? Okay, or is it kind of like, is this information something that I cannot use to compare and try and understand a particular situation? Like, can you compare with the other companies in the industry, or can you compare with different situations of the company related to even a project? So there should be relevance. Okay, so the other, the qualitative characteristic is reliability. Now, when it comes to information, it should be reliable. Now, it should be free of error and bias, and that is what we expect from the information, because if there is certain error or bias, then obviously it would be difficult to in decision making, right? So if there is some kind of error, then obviously you will wonder, okay, right, is this is this information sufficient for me to make this particular decision, like to invest in a particular company? Is this sufficient for me to decide upon, right? So it should be very, the information should be reliable. The fourth characteristic is the comparability. So now what is comparability? The information that is given should be able to be compared, like the entity's past and the present performance. So if let's say the financial statements are, ad hoc, just made according to whatever they want, can we compare it? No, right? So it should be all the years, the financial statement should be prepared in a specific way. If it's prepared in the specific, the same method, only then you can compare. Like if there's a, let's say there's a profit. So if it's not computed in the same way, can we compare between years? No, you cannot. So it should be, we should be able to compare it with the past and present performance. And also, they should be able to identify the application of the accounting policies. As for, okay, when they are, deciding upon something, they should be able to see, okay, right, what accounting policy have they used, right? If there are 2-3 example, let's say, let's say we when it comes to written down value of a particular company machinery, they need to see, okay, right, is this all these, are they completed based on straight line method? Okay, is it computed that way, or what method is used? Because according to what is used, obviously the outcome will be different. So one of the qualitative characteristic is the comparability. Moving on, we have to look at the elements of the financial statement. So the framework basically provides 5 definitions for the financial statement. It will provide like insight to financial effect of the transaction and guidance on how it should be recognized in the financial statement as well. So now, one of the things that we always talk about when we talk about IASs and IFRSs is the recognition of a particular element and the measurement. So like according to the framework, when it comes to an item, it should be recognized in a specific way, right? So this recognition, how is it recognized? It needs to be included so that the decision making, the user can understand, how these elements are recognized. And when it comes to measurement, it is necessary to kind of determine the basics that are used in order to measure the particular item and how this item line has this particular value. So measurement, it is very like the proper like the people should be able to recognize the financial statement based on how it is measured. These elements are measured. So, and then we will move on to concept of capital and capital maintenance. Now, when we look at the capital, there are 2 concepts when it comes to capital. One is the physical concept, and the other one is like basically this is something, this is something to do with like the net assets, and these are widely adopted by the companies, because when it comes to land, building, machinery, these are things that will be included, and these are like physical. It could also be intangible as well. So capital maintenance. Now when there is an entity has to maintain the capital, so end of the period and the beginning of the period, the capital maintenance, how it is maintained, it needs to be included, and the basis of the profit needs to be calculated as well. Now, with that, we came up to kind of understand what is included in the framework. And now we will look at the usefulness of a conceptual framework and ISP's standard setting process. Now, basically, when it comes to the standard setting process, it basically gives us like a guidance on the broad principles and how items should be recorded, measured, or even when it comes to presentation. So now when we look at the conceptual framework, it basically provides like a reference for preparers of the financial statement. And do we have standards? There are no standards which are specifically covered in this issue. And when it comes to framework providing guidance or definition, all these will be kind of included as well. So framework basically provide assistance in event accounting standards are less prescriptive and also help to kind of remove the need to repeatedly address the underlying issues. And it could also assist the standard setter to kind of develop the accounting standard that follow a specific consistent approach in order to recognize or even to measure a certain section. Also, when it comes to the framework, it kind of provides a short-term solution for the technical issues or even to like a specific standard which is developed as well. Now we are moving on to the audit engagement. Now, what is audit engagement? This is basically like an arrangement which is between the auditor and the shareholder. So like this is basically in order to give opinion regarding like the financial statements of the organization, the management of the organization should be able to kind of understand the expectation of the auditor and provide all sorts of, provide all necessary information to the auditor. And when it comes to large corporation, they need to carry out the audits as part of the statutory requirement in order to make importance of auditing for larger for them. Now we will be moving on to true and fair presentation. Now, when it comes to the qualitative characteristics of a financial statement, one thing that we always expect is that the financial statement should be reliable, right? Now, it should have this faithful representation of the financial statement. And so when we look at the basic idea, it should occur during the year it happened. I'm very sorry about that. So it should have this fair representation of the accounting standard, and there should be relevant reporting framework. Moving on, we are going to talk about external audit. What is external audit? So when we look at external audit, these are audits which are basically carried out by external auditors. These are not auditors inside the organization. When it comes to large corporations, which are quoted, there is like a statutory requirement where the organization need to kind of produce audits which are carried out by carried out by external auditors, right? So now even without a legal requirement, like some small organization do it. However, these legal requirement, of course, will change according to country to country. Now, when we look at the objective of like an external audit, we need to understand that an opinion on the information given in the financial statement and the position and the outcome is based on whether the financial statements are prepared in a true and fair manner or whether it's prepared subject to a particular financial reporting framework. So, when the general principles are followed by an auditor, it would be basically in compliance with the ethical principle or applicable auditing standard. And when you're carrying out the audit with a professional professional, what they do is the auditor will have a, this, they should view that financial statement with a question in mind, like in a critical assessment, and identify the material misstatements. Now we are moving on to the statutory audit. Now, what is a statutory audit? This is basically like a legal requirement, like for financial statement, in order to assess the reliability of the organization's financial reporting. So these type of reports are generally done like in a timely manner and are generally known by any non-professional. So like when it comes to certain organization which doesn't have like a legal requirement to have statutory audit, they perform them in order to kind of reflect transparency and to relevant stakeholders prior to request by them. So this is basically considered as good governance practice and a norm in certain industries. So now we will look at the structure of the bodies of the auditing standards. Okay, so you have the IFAC, the International Federation of Accounts, and under them you have the IMAC Code of Ethics and also the IAASB, which is the International Auditing and Assurance Standard Board. And then under them you get the ISAS, that is the International Standards on Auditing, then the ISQCSS, which is the International Standards on Quality Control. This is the structure of the IFAC bodies. I know like these are all theoretical things, but we need to just basically kind of understand what these mean. So like audit committee is basically like a formally constituted by subcommittees which would have like a main body who meet like twice a year. There would be like a membership committee which would have like at least 3 directors and would have independent company, and also like primary functions related to stewardship responsibilities, and also like external audit process and the work of internal audit and financial information which is provided to shareholders. Now we will be looking at the main roles and responsibilities of the audit committee, which will we will be talking about 5 of them. So one is to monitor the integrity of the organization's financial statement. Thereafter, they would be reviewing the organization's internal control and the risk management system. They will review that. And then after that, to ensure the effectiveness of the international audit function. So the effectiveness was checked and ensured by the audit committee. And then the reviewing and monitoring the external auditor independence, objectivity, and ensuring that the effectiveness of the audit process. And lastly, making recommendation to the board to place a resolution before shareholders in an annual general meeting in order to appoint or even reappoint and remove any external auditors, to approve the terms of remuneration and engagement of the external auditor. Now we will be looking at the audit process and what are the steps in this process. Now, if you just look at the broad outline of an audit, the first step is basically the auditor is generally appointed by the firm's annual AGM or the annual general meeting, and it will be effective until the next AGM. So what happens is, as you can see here, auditor will be appointed, then they will collect all the evidence, and the audit opinion will be formed and a report is kind of formed. And then this audit report will be published, and then the auditor will attend a AGM where they will be reappointed, or if there is an issue, they won't be appointed or someone else will be appointed. So this is the basic steps in the audit cycle. Moving on, we will be talking about audit report as of what audit report is. Now, objective of an auditor. What is the main reason an auditor is recruited also? They will be measuring the financial statement of the company to see whether it is presented in true and fair view when it comes to things such as the financial operation and the financial position. And they will express their opinion through like a written report. Now, when it comes to forming this particular opinion, what happens is, to form the opinion, the auditor must first gather the adequate and relevant audit evidence through appropriate audit procedures in order to conclude with that it's like a reasonable guarantee to the financial statement, or with their free of material misstatements, and also things like accounting policies, accounting estimates, and the use of terminology or disclosure should be put under the specific scrutiny as well. Moving on, we will just look into like the contents of audit reports. So they will have like a title and then who it should be addressed. So now this says title should be appropriate and distinguished from other audit reports such as internal audit report. Okay, so title should be made such, and address should be addressed to the intended users, and there should be like a introductory paragraph which will identify the company and states that the financial statements are audited, and the content of the financial statements and accounting policies and the period covered in the financial statement. Now, when we look at the scope, which will have like the balance sheet, profit and loss, cash flow, as well as the statement of total recognized gains and losses. Moving on, looking at the scope, there is like a statutory duty of the auditor, which should include the accurate accounting records, and that the financial statements are in line with the primary records and return, that they are suitable and received from the branches not visited by the auditor, and that there is sufficient proof and explanation which are made accessible to the auditor by the respective personnel of the client, and that the director's report is in line with the financial statement. And when it comes to statement of responsibility of auditors, what happens is it is expressed opinion by stating the audit was conducted in accordance with the ISAs and the ethical standards, and what kind of audit procedures are used and things of that sort. An auditor's opinion will say phrases, and what phrases are, as you can see, the date, auditor's address, and the statement and responsibilities, all these will be kind of included. Now, auditor's opinion, there are two types of opinion. One is called qualified opinion. So qualified opinions are basically provided when the auditor's judgment is persuasive on a particular matter. These opinions can occur when the financial statement have been materially misstated and the auditor is incapable of obtaining adequate and relevant proof. Okay, and there could even be an adverse opinion when the auditor considered a particular matter to both material and pervasive, and like the statement to be that it is materially misstated, and like they can provide like a adverse opinion on the financial statement. Now, audit opinion, there is kind of like a disclaimer opinion when the auditor considered like a particular matter both in material and pervasive, and even cannot gather like adequate related evidence and provide like a adverse opinion on the financial statement. A disclaimer will basically refer to like the auditors abstaining from providing an opinion on the financial statement. And emphasis of matter. So this is basically additional paragraph which will be used to kind of modify an audit opinion, where the emphasis of matter paragraph basically states that the financial statements are presented fairly in all aspects with its particular matter highlighted in the paragraph. So other matters like national laws, pervasive restrictions, and the client follows to accounting standards, all these will be included as well. So now we covered the regulatory and audit process, which is basically like an area obviously a lot of theory involved. And we will now move on to interest rate risk and hedging techniques. I think it will be a little more interesting than what we were talking before. So interest rate risk, what is it? So basically this is like a financial risk that emerge due to kind of like fluctuations in the interest rate. So every company is kind of exposed to kind of an interest rate risk, right? So when it comes to in-depth understanding about the concept risk, how the interest rate risk arises in the finances and the business environment is very important to any organization. So interest rate risk is like the risk which is generated by the interest rate fluctuation. Okay, so based on this particular way an economy or currency happen, this will affect a company and expose it to a risk in a different manner, right? So when a company has debts with fluctuating or floating interest rate, or when there is an investment and expansion project which will be affected by the volatility in interest rate, or even when the interest rate movements directly affect the future cash flows by affecting the customer's disposable income, all these will be included as the interest rate risk. Okay, basically when it comes to the degree of interest rate risk faced by the company, it will depend mainly on the following factors. One is the capital structure of the company. So this will be like a mix between what? The equity and wealth as well as debt. So higher the debt capital, higher it will be the interest rate risk. This we do, right? So mix of fixed and floating rate debt in a company, also the mix of long-term and short-term debt in the company as well. Now let's look at the interest rate risk management. So interest rate risk is basically considered as a major type of risk in which every company is exposed. Now, organizations should basically manage interest rate quickly as possible in order to experience and benefit. And basically, this section will kind of include the interest rate management and techniques that are used to manage the risk. So, following techniques will be used here. So, internal, there will be hedging techniques, smoothing, matching, and netting. Then the external hedging techniques which are used would be forward rate agreement, interest rate future, then the interest rate option, which can be interest rate cap, interest rate flow, interest rate collar, or even interest rate swaps. So all these will be used in interest rate risk management. Moving on, we'll be talking about hedging. Now, hedging basically deals with the currency risk prevailing in an organization. Like when there is a decision which has to be made first whether hedging is required or not, it will be performed based on something like scale of the risk, cost of hedging, and availability of funds. Like how we decide upon the other things, right? So all the things related to like the scale and cost and availability, all these will be considered similar to how decisions related to even sources of finances are done. This will be used when it comes to using this type of hedging technique. So when it comes to hedging techniques, I said there are two specific techniques that I use. One is internal hedging technique, the other is external hedging technique. Going back here, we were talking that we said there are three internal hedging techniques and external, we spoke about 4, right? And how it works. Oops. I think I just kind of, sorry. I'm very sorry. So internal hedging techniques. I'm sorry about that. So I said there are 3 internal hedging techniques. One is called smoothing. So smoothing is basically like refers to like an appropriate mix of floating and fixed rate debt. So this big depends on the organization's expectation on the future interest rate and how the interest rate is outlooked and the cost of borrowing as well. So the organization will have like a mix of appropriate floating and fixed rate debt here. And like, now you would wonder what is this for the, what's the difference and all that. So let me give you an example. So when it comes to an organization which has a mix of loans, let's say one loan has a fixed rate, which is 10%, and the other loan has a variable rate, which is LIBOR plus 0.3. This is the mix of loans that I use for smoothing. Okay. Now let's look at matching. So matching will be basically performed by matching the assets and the liabilities of the company. So it basically indicates if the assets of the entity have a specific mix of fixed or floating rate interest, then the borrowing should basically will be the same mix. So the maturity of the assets and liabilities should be matched, and long-term assets should be financed by the long-term borrowing. Like that, the same thing will be matched upon. So that's why you call it matching. Now, the other method is netting. So what is netting? Netting is like a technique which is mainly used to reduce the transaction cost, which is arised by the multiple currency conversion, especially when it comes to MNCs with subsidiaries around the world. Use this technique. Okay. So basically, so difference is here you use to technique used to reduce the transaction cost, which is netting. Matching is you match the assets and liabilities, and smoothing is you have a mix of floating and fixed rate debt. So these are all internal hedging techniques. Now let's move on to external hedging techniques. In the table, you saw that there's a lot of external hedging technique. So now when it comes to a company, they may hedge its currency risk with use of derivatives, right? So you know what derivative is, which is like a financial instrument which will value would kind of depend upon the other underlying asset. And so we look at how the external hedging techniques are used. So there is something called forward rate agreement of FRA. So now what is FRA? This is basically a fixed interest rate agreement in which an interest rate is agreed today for future borrowing. Like the FRA is like an obligation where you agree for interest rate today, which is for future borrowing. So this is an obligation. So the company has to fulfill the company obligation irrespective of the marketed rate because you agreed upon it today itself. So under the FRA agreement, on the future date, the buyer or seller of FRA contract depending on which way the rate goes, the one party will have to pay the difference between the FRA rate and the actual rate. So that is a forward rate agreement where you agree to it today and you are going to do a future borrowing or payment on a future date. Now we'll look at interest rate futures. What is it? This is basically an exchange traded instrument which are usually come in standard size. So the company may not be able to hedge them completely. So it will only be hedged partly. Now we will move on to what? The interest rate option. So interest rate option is like the right to pay or receive a particular amount of interest. So they will consider long-term interest options such as interest rate cap. So what is the interest rate cap? This basically refers to like fixing a maximum interest rate payment or having a premium to be paid to the lenders by the borrower, where you have like a cap. You say, okay, this is the amount that you are supposed to pay. You are not fixing fixing a maximum. So you don't have to pay more than that, right? You will only be paying less than that. So interest rate flow. So from just the name, you should be able to understand. When you say cap, obviously cap is something on top. So that means there will be a cap, as in this is the maximum that will be paid. When it comes to interest rate flow, it's the minimum interest rate for the lender. So flow means obviously it's down. So with the name itself, you should be able to understand what it is. So interest rate flow is like quantifying a minimum interest rate for the lender. So interest rate column. Now what does interest rate column mean? It basically indicates the difference between the interest rate cap and then the flow. Now you have a cap, right? There is a maximum amount which is the premium to be paid to the lender by the borrower. Then there is a flow, which is a minimum. So the gap between it is called the column. So difference between these two is the column. So I just hope you understood what I mean. So the last one is called interest rate swaps. So what is an interest rate swap? So we're like talking the last external hedging technique, which is interest rate swap. So interest rate swap basically enables a company to convert its debt to another, right? Company should basically undertake the interest rate swap for there could be many reasons, and that we have listed down 5 reasons. Okay, so basically it could be something like to convert a fixed rate debt into a floating rate debt, or vice versa. That is, it could be to convert to a floating rate debt to a fixed rate debt. So you use interest rate swaps for that. The other reason is to convert long-term to short-term or vice versa. So interest rate swaps will happen if you want to convert something long-term to short-term, or convert something which is short-term to long-term, right? And the other one is to reduce or to kind of speculate on the future interest rate. So the other one is to kind of speculate on how future interest rate would be. I mean, speculative think, right? With the future interest rate would be higher, or will it be lower? So for that, what do we look into? Obviously, you look at the situation of the business environment, right? The country situation or the industry situation to see how the future interest rate would be. Okay, if there is, let's say there is an expectation, that there could be a certain, let's say, recession. Okay, when there is a recession, how would the speculation of the future interest rate would be? It would obviously, you'd speculate that the interest rate would go down. So that's how the interest rate swaps happen. Another way is to reduce the cost of borrowing. Now that there is a cost of borrowing, right? So if you borrow something and then you sell it and then you borrow another one, okay, then there is this cost of borrowing involved. So when you do swaps, what you do is you kind of you give something and then get something, and that cost of borrowing is not there. So basically here what happens is you kind of swap things like the fixed rate to floating rate or floating rate to fixed rate, long-term borrowing, something or short-term kind of a debt, or something which is short-term debt instrument to a long-term instrument, or it could basically it would help to speculate the future interest rate using the interest rate swaps and to match assets and liabilities. So we were talking about how matching assets and liabilities happen. So this could interest rate swaps could be used in order to match the assets and liabilities of a company. So with that, we've actually completed interest rate risk and the hedging technique. So I don't want to move on to a new section where we are going to talk about taxation. So in the last two sessions, we will be talking about taxation. I hope that you understood whatever I explained to you so far. So we've been talking about today, we barely talked about interest rate and the hedging techniques. That is one of the main parts that we spoke. Hopefully it was short. However, we spoke about different hedging techniques. So one thing I would want you to remember is how the, hold on, sorry, is for you to just remember this, what interest rate risk is and the interest rate risk management, how it is done to method internal hedging techniques, external, and what these are. So we talked about these methods. So if you remember this particular table and interest rate risk management, you should be able to kind of get a good idea about it. However, if you want, you can obviously move on and read about these to get a better understanding. If you cannot understand what I meant through reading, you will understand more practical application related to it. And obviously today, half of today and last week, we were talking about regulatory and audit process, where we spoke about auditing, how it happens, and different regulatory, committees related, because you need to understand what these committees do. I know it's a lot of theory, but we follow kind of completed those so that you can have a better understanding of how all these things happen. I mean, just knowing is not enough. You need to understand how all these things happen. Okay, I'm very sorry if I'm really not clear. I'm having a small cold today due to the weather. I'm very sorry if I'm unclear. And I hope you had a good understanding about what I explained to you today. And I just, you could kind of go through the recording again, or go through the PPTs, or read through all this section that we talked about, and kind of see whether you will understand this specific section. You can go through different books and even blogs related or business magazines which talk about application. It is very important for you to understand the application. So with that, you should be able to understand these areas better. And we've actually covered 7 sections, right? 7 lessons, where That means we only have 10 lessons altogether, and we completed most of the sessions now. So I hope you really do understand what is what is taught in this session, and that you should be able to apply whatever is taught, go through the learning outcomes. We've covered it in a different way, but I tried my best to complete everything properly. You could go through them and then read related books and material given in your module specification, and try and see whether you can understand what is taught there. I mean, the contents that are included there, so that you will be able to get a better understanding of the module content, so that you can cover, complete your module assessment well. I just hope that you will be able to cover it well. And thank you everyone for listening to me. If you have been listening to this whole video, I know, yeah, my voice doesn't sound so well. And thank you for listening if you have been listening to me. I'm very sorry if anything was unclear. Thank you everyone. Have a nice day. See you next week. See you.